Best thing to do is you always want to start with some rules. And the purpose you use the rules for, of course, is to train your subconscious mind. It makes you less impulsive about jumping in and jumping out. And it trains you to look at each of the individual bars. And then after a while, everything will become very intuitive to you. So for now, we're going to start with the most basic of basic rules, identifying reversal bar as the high of the low bar, low of the high bar, maybe put on some rudimentary targets and some kind of a stop loss and some kind of an angle to determine if we're in an uptrend or a downtrend. And the basic rule we're starting with here is we're only going to trade long if we're above a 45-degree angle. Now, as you've seen prior, there are many ways to calculate a properly scaled 45 besides just drawing a 45 degree on your chart. But in principle, when I refer to the 45, for now it just means that whatever scale you're going to use, and hopefully it will be a properly drawn chart with a good scale, but the idea is we want to trade stocks long that are actually going up. And they won't be going up if they're below a 45-degree angle. And then if we do trade long above the 45-degree angle, the reversal bar that we see is only made to liquidate and not go short. Because usually you just have a small little pullback of 3 or 4 bars and then you'll go right back to a new high. So as long as you're still above a 45-degree angle and you see a reversal sell signal, basically, you liquidate your long and look to regroup and go long again. The only time we're going to go short is when you actually have moved over enough in time and price on the chart that you've broken through the 45 from the last low, and then you get a reversal sell signal and you're actually declining under a 45 degree from that high. And that point you will be going short. For this preliminary study, we'll use a trailing stop of 3 bars back. So under any circumstances, basically, if the market plunges back 3 bars, we'd be stopped out. But in most cases, if we have a runaway move, that won't happen, and we would be selling at the signal reversal bar. Remember, once we identify the high of the move so far on a day-to-day basis, identify the highest bar when it breaks the low under that bar. If we are at one of our measured move targets, we use that to exit. If we are not at one of those measured move targets, we will stay in the trade, even with the reversal signal bar, and we'll use a trailing stop of the low bar just before the reversal bar. So when you identify that high bar, pick the bar leading up to that. Because believe it or not, 80% of the time, there's a great big giant bar up, and then you get a little sell signal. And you'd have to go all the way back down that giant bar up before you really could change the trend. In most cases, you just get a 1, 2, or 3 little bar down, and then they go up again. But if you have a series of little tiny bars that are pushing up to new highs and they fail, then when you break both the signal reversal bar and the bar before that, it's usually a legitimate sell. And I also say if stopped out, get back in if you have 100% retracement of the bar you were stopped out on. Sometimes they just run the stops, especially on the E-minis. They do it all the time just to get you, and then they run back up. And so if you're above the 45-degree angle in a long, you get stopped out. You can get right back in if the market's going to close on that bar back above where your stop-out level was. So consider stops basically on closes. You have to have a stop intraday and intrabar to protect yourself in case there is a crash. But often if you get stopped out when they just run stops and the overall trend is strong, if that bar closes back up above your stop, then that was basically just a whipsaw. You have to get in and assume the stop was not really violated. Commissions are very cheap, so it doesn't cost you anything to get back in, and you don't want to lose your position. So let's look now at a chart, and we see the 60-minute E-mini chart here, and there's been a decline. So we're looking for an entry point. We've identified the lowest bar of the move on the downside, and it's reversed, and we've identified the high of the low bar. Now, somewhere above this level of the high of the low bar, we want to go long. Now, whether or not we do it immediately or we let them go up a little and have a pullback to enter, that requires a little discretion. Preferably, you give it 3 or 4 bars up and a pullback and enter, or you have some angles coming down off the top here that are less steep, and when you break out of an angle you would go long. I can see visually there's an angle coming through here, which is probably this angle, and they pull back to test the high of that angle, and this bar ideally would be an entry well above here. But regardless of where your entry point is, we've identified the place where the low was made, and now we have a problem because as you move your charts around, they're going to be misscaled all the time. So initially we have to do a quick and dirty scale of what would be a good 45. We don't have a first high or low to use to put my 4x1 angle method on and find a true 45. So one best way is to turn horizontally the trigger bar, and I said the best way to do that is use a circle, and that way the radius vector horizontally would be a 1x1, and the 45-degree angle going up through that would be a decent 45 angle that you could use. So in this case, as long as they're above this 45, we're going to continue to trade long. We would not go short up in here because you're still above the 45, but you might get stopped out here and look to reposition at some point. After we've quickly put on our 45-degree angle, we also want to put on some quick and dirty targets. Now you could use my ratio lines if you want to calculate them, but sometimes the market's moving too fast, and if you only have 5 or 10 minutes, although this is an hourly chart, so you can see you have 3-4 hours in here to put these on and be very precise. But you could just do the measured move idea of the doubling the width of the reversal bar, doubling it again, and you'll see there'll be a little hesitation here where that would be your minimum target under any circumstances, but I usually wouldn't trade there. I would fully expect them usually to go to this level or the doubling again from that, which turned out to be the big top. There was a little top here at the intermediate term, and you can see an intermediate like a midpoint break here, but the primary target given from the doubling and the doubling again gave us a bigger target over here. So now we have our targets, and now we have a 45. And now once we're long somewhere in here, whether you bought in here or here, it's a question. If you bought immediately here, you might have been stopped out at this low. But usually on the very first time I get in, I'll use the low bar itself as a stop until I start getting away from this range. Once I get up in here or so, then I'll start using a trailing stop of the 3 bars back in order to protect myself. But I use a wider bar for the first 3 or 4 bars. Now let's look at where our stops would be as we start to move up here. Initially, if you had bought immediately crossing up in here, the high of the low bar, there's a question. You may have been stopped out if you used the 45-degree angle somewhere at this point. If you had a bigger stop down here, you weren't stopped out. But noting our rule that if you were stopped out and you have 100% retracement, you have to get back in. Now note over here, there's a little bar you may not be able to see too well, but this is where it opened. So it opened here, stopped you out, and then zoomed up. So as from that point of the bar, if it was a day, it was a day. But during that hour, the fact that you were stopped out here and then you exceed that opening level, this is like 100% reversal. So somewhere up in here, certainly crossing the previous high of a bar or two ago, you'd have to get back long again. And then we go up to our first target area. So one of the rules is you could use a signal reversal bar at a target area. So the question is this the breakdown here of the signal reversal bar low? Sometimes it's a little bit subjective. If there's no momentum and there's a tiny overlap, I usually don't sell out anyway. But the rule, remember, as we said, is use the bar before the signal reversal bar. So this is the bar before the signal reversal bar. So if we were going to respect the sell signal generated here, let's look at the bar before and use that still as our stop. So we're not stopped out here. Then we go up into this area and we're at our target, but we blow right on through. So now we get a big bar we identify over in here as the high of the move, but it's a great big giant bar. And usually you see the big giant bars often only have corrections that go sideways down to where they started from. This happens the vast majority of cases, that they only retrace the width of that bar. So that's why I usually use the stop at the low of the bar preceding that. So this would be your stop on a big bar like this, and you could ride out this correction. And you would also see on your targets you're pulling back to a potential support area at this 50% marker. So you're still in it from here. You're going on up. Now we have another, you're at one of the targets again. And you do have a signal reversal bar. This is the high of the low. We've broken it at this point, and we look at the bar before that. And the bar before that, too, was broken. So we would be stopped out here. And we would not be going short because we're well above the 45. So we'd just be waiting to see if we can find a better entry point. Then we have a little creep back. You don't really have 100% retracement right away. Even if you jump back in here as 100% retracement, you would have to immediately reiterate the sell stop if you had bought them here and you got to this point. But no matter what, this would be your permanent stop until you get back in again. And then we see we have a big breakdown. They bounce off the level, but we can't buy just on here because there's no pattern of a buy. We go down to a low that approaches one of our targets, and we could identify down here the high of the low bar and go long in here with a trailing stop 3 bars back. Remember, the trailing stop is the 3rd bar back unless it's a signal reversal bar, and then we use the bar immediately before that. And then we see we work our way back up the angle again to another high. After we get stopped out and we have our correction here, first thing we want to do, of course, is put on our retracement lines. And so we can see where the resistance is. Now, you may have gone long here at this high of the low bar, though I say it's not a safe long yet because it's a pretty strong decline. A safer entry point would be when you cross the 50% level of the swing down. So you could always buy it in here above the 50% and use your trailing stop at that point. Note, too, the 45-degree angle now I have shifted. I have borrowed it from over here and dragged it over, knowing that the slopes from the low to the highs usually repeat identically. So do these 45s and stop out angles. They will hold in the same proportion on each leg. So now we move the 45 over into here, and that will serve us fairly well. We go on up here. Here's a high of the low bar, but it doesn't really break. Here's another high of the low bar, but we check the second one bar before that, so we don't get stopped out here either, even though you had a little 3 bar down, but it's only coming down to the bar immediately before. Then we, even if we did get out, we could get back in here. So ultimately, up in here, here's the high of the move so far, a little sell signal. The low of that move is here, so you'd be stopped out over in this area. And then we watch to see an entry point. There's not much of one. If you did take this little buy signal here as an entry point, you could identify the next sell signal either in here or right back down here. Now at this point, the market does start to trend down. And once it breaks under the 45, it's now eligible to be shorted on any rally because you are now under the support from the last low, and you're coming down on a 45-degree off the top. So you've entered the bear side of the market. So now the first thing we've done as we enter the bear side here is we can put on our targets again. We can take the width of our top bar and shoot down some of these doubling angles. Double the width, double it again, double it, and we can see ultimately they work pretty well. So as we get through these targets, there's no short that we could have made as yet until they broke under our 45 according to our rules. So once they get down here on a snapback, you could have tried a short right here potentially as they went down, came back and hit their head under it at a resistance point. If you didn't take that one, you could have taken this one based on the overlap of the bar. Now note you wouldn't have taken it as it broke out because it could have kept on going. But what happened, you see the low opening level here, opens up, and then it goes down. And when it goes down and goes below this 75% pivot, and you're under the prior bar, you could put a short off there because you are trading in the bear side of the market. And then it comes down to a target area. So when we hit a target area and we get a potential buy signal, we could cover at this point if we wanted to, if we didn't want to use a big trailing stop from way back over here. but no longs would be made because we are now under the 45 from the preceding low, and we